Welcome back to my channel. I'm Lucy and today I'm going to give you the exact dates that you need to be prepared for, tips to organise yourself and strategies to help you stay on top of your taxes. This way you can avoid unnecessary penalties and keep more of your hard-earned money. Let's talk about some key dates and deadlines that you need to be aware of to be able to stay compliant and to avoid any penalties whatsoever. Tax year in the UK runs from the 6th of April to the 5th of April every single year. This is the tax year. It's for everyone. So at the beginning of the year on the 6th of April, you can review any new tax changes. So things do change as you go into a new tax year, so do be aware of this. You want to update employee wages according to the new minimum wage rates, if applicable. You want to update accounting software with new rates and regulations. So all of your softwares need to be up to date. Now we get to the end of our tax year next year, 5th of April. This is our time to finalise all accounts and transactions. We also want to ensure that all income and expenses are recorded, and if we want them to land in that financial year, they need to be before the year end. We can then prepare for that upcoming self-assessment tax return, which yes is due next January, but it's best to keep on top of things as soon as the year ends. If you're a sole trader or a director, do not forget these dates. So on the 31st of January, you need to submit your self-assessment tax return to HMRC. You will also need to pay any taxes due for the previous tax year. And if you're on payments on account, then you may need to make your first payment on account if required. We also have the 31st of July. This is when you will make your second payment on account. If you don't understand what I'm going on about with payments on account, please see the link above for our video explaining payments on account. So for VAT registered businesses, calculate your VAT liability regularly and file the returns as required, whether that's monthly, quarterly or annually. And if you're thinking about going VAT registered, check out our free downloadable guide below. I'm going to put it in the description to help you decide whether it's right for you to take the next step. So you want to calculate your VAT liability, so your output VAT, I know it sounds scary, but it's just your sales, minus your input VAT, so your purchases. You then need to submit your VAT return to HMRC, pay the net VAT amount due, so the difference. Most businesses operate on a quarterly basis, with the deadline being 1 month and 7 days after the quarter end. This is not only the submission deadline, but the payment deadline too. The first deadline is the 6th of July. Every year you need to submit a P11D and a P11DB form to report your employees' benefits and expenses. This is if they have company cars and other benefits like private medical insurance. You need to then provide your employees with a copy of their P11D. The next date I have for you is the 19th of July. On the 19th of July, you need to pay Class 1A national insurance on benefits provided to the employee. Pay PAYE, which is pay as you earn, and national insurance contributions to HMRC by the 22nd of the following month if you're paying electronically. If you're paying by cheque, it's the 19th. Quarterly PAYE payments for small employers. This is due by the 22nd of the month following the end of the quarter. So April, July, October, January. 6th of April. From the 6th of April, you can issue P60 forms to employees for the previous tax year. Basically, it's a breakdown of all of your pay-as-you-earn income throughout the tax year. 19th of April. This is your final submission of the previous tax year's PAYE information in what's known as an FPS, which is a full payment submission. This is really important because it sends all the information across to HMRC. This is something normally your accountant or your payroll bureau will be doing for you most of the time. Corporation tax. For limited companies, pay your corporation tax 9 months and 1 day after the end of your accounting period. You also need to file your corporation tax return, which is your CT600 with HMRC. Limited companies will also have annual accounts. File your annual accounts with Companies House. So for limited companies, you will need to complete a confirmation statement annually. And this is usually the same date every year. What you want to do is you file a confirmation statement with Companies House, updating the company details. This is basically just saying our address hasn't changed, directors, shareholders are the same, shareholding structures the same, etc. Your accountant can normally complete this on your behalf as well and pick up any anomalies with persons of significant control and things like that. My advice is to also go on Companies House. You can literally type into Google Companies House. It will come up with a record and you want to search for a company. Search your own company in there and look at your record on Companies House. You'll know if it's yours by going to the people section and seeing your name there. This is super important because here is where you can find out when your confirmation statement is due. So it's going to be at the same time each year. Make a note, put it in your diary. You can thank me later. Let's talk about some practical tips to help you stay on top of your taxes and to avoid those dreaded penalties. So first things first, set those reminders. Use your iPhone calendar, your Google calendar, or even if you've got one on your kitchen wall, if that's how you work, just make sure that you've got all of your key deadlines marked well in advance. This simple step is going to save you tons of stress and help you avoid any late fees. Next, let's talk about bookkeeping. Keep your financial records up to date. We've got a fantastic free checklist that you can download in the description below to help you stay on top of all of it. By regularly reviewing your accounts, you'll have all the necessary information ready when deadlines roll around. As part of this routine, make it a habit to transfer a percentage of your earnings into what I call your tax pot. More on that in a bit. I get it. If numbers are not your thing, consider working with an accountant or a bookkeeper, and they're going to help you to stay compliant, provide you with valuable financial advice, and even help you with determining the exact right percentage to put into your tax pot. I know I would say this, but trust me, this is an investment that pays off. And lastly, automate as much as you can. Use accounting software that handles tasks like your invoicing, your expense tracking, and it integrates perfectly with your apps. This is really important because if you're using other apps and softwares in your business, they should be talking to one another. It's going to save you tons of time, reduce the risk of errors, and yes, you can even automate those transfers into your tax pot, which is super convenient. So what is this tax pot method I keep mentioning? It's a super simple yet very effective way to manage your tax liabilities. Essentially, you set aside a percentage of your income into a separate account specifically for tax payments. That way, when your tax bills are due, the money's already there. There's no scrambling last minute and no more using money that was meant for taxes on other expenses. Here's how you get started with the tax pot method. Calculate your tax rate. Estimate what percentage of your income you need to save for taxes. You need to include all the taxes here. So this could include your corporation tax, your VAT, personal tax if you're a sole trader, or if you have other income. Set up a separate account. Open a separate bank account just for your tax savings. Some banks, just like Starling, even offer sub-accounts to help you manage your finances better. Starling do fantastic tax pots, which are still part of the same account, so you can have all different pots for different things. And these are called spaces through Starling. They're called different things through different banks. Every time you receive income, transfer the calculated percentage into your tax account. For instance, if you decide to set aside 20%, then for every £1,000 that you earn, move £200 into your tax pot. Regularly review your tax pot to ensure you're setting aside enough. Adjust the amounts based on the business's performance, any changes in tax laws, etc. So when a new budget comes out, you may need to do some tweaks here. By regularly setting aside the money, you're going to have the funds ready for when those tax payments are due. This is going to instantly improve your cash flow management. Cash flow management is super important and not to be overlooked. With a dedicated tax pot, you will always know how much you've saved for each type of tax. This method helps with better financial planning and budgeting, allowing you to be able to focus on growing your business without the constant worry of tax obligations. Missing deadlines doesn't just mean extra stress. It can also lead to penalties and fines that add up really, really quickly, including interest on top of them. So staying on top of your deadlines helps you to avoid any unnecessary costs. It maintains good financial health, but it also builds trust with HMRC. Also, having your tax pots in place is going to give you the peace of mind knowing that your finances are completely in order. And that's a wrap. By understanding these deadlines and using practical strategies like the tax pot method, you can keep your business finances healthy and compliant. Remember, staying organised and proactive is key. If you found this video helpful, please don't forget, give it a thumbs up, subscribe to the channel for more business tips. And until next time, keep smashing those goals. See you later.